The global economy is sitting on a time bomb, and the clock is ticking. This bomb isn't made of conventional explosives, but something far more widespread and dangerous: debt. For decades, we've been told a comforting story. We've been sold the idea that we can borrow our way to prosperity, that piling on debt keeps the economic engine humming, and that the good times will never end. Central bankers, politicians, and Wall Street have all preached from the same script, promising that growth is just around the corner, fueled by ever cheaper money. But what happens when the bill finally comes due? What happens when the very fuel that powered the markets for a generation becomes the explosive that tears it all down? Underneath the shiny surface of record-high stock markets and reassuring headlines, a much more fragile and dangerous reality is brewing. The entire global financial system is now floating on a bubble of borrowed money so vast and so precarious it dwarfs anything the world has ever seen. This isn't just another cycle. This isn't a temporary dip or a minor correction. The sheer scale of this leverage is a massive, flashing red light, echoing the conditions that came right before the most devastating financial crashes in modern history. The patterns we see today aren't just similar to those before 1929, 2000, and 2008. In many ways, they're far more extreme. When this debt bomb finally explodes, it won't be a slow decline. It will trigger a waterfall of forced selling, a violent unwinding of leverage that will spare no one. You need to be ready. This isn't about scaring you. It's about understanding the raw mechanics of the market. Today, we're going to dissect the anatomy of this ticking time bomb. We'll look at the historical screams from the past that are warning us of what's to come. And most importantly, we will cover the concrete steps you can take to prepare for the fallout. Let's get specific. So what's the grand total? According to the Institute of International Finance, by late 2025, the world was buried under a nearly $346 trillion mountain of debt. That's not just a number. It's a figure so huge it's hard to comprehend. That number represents a promise that all this borrowed money can and will be paid back with interest. It's a promise that looks mathematically impossible to keep. Other sources like the IMF report a lower figure of around $251 trillion, which is still a staggering 235% of the world's GDP. The difference often comes down to whether you include financial sector debt, but either way you slice it, the number is astronomically high. Most people don't grasp how fragile this makes our entire system. In this video, we'll break down exactly how this time bomb was built and why one wrong move could set off a global financial collapse. To really get the danger we're in, you have to see the debt for what it is. This isn't one single problem. It's a three-headed monster, and each head is more ravenous than the last. Government debt, corporate debt, and consumer debt. All three are now flashing bright red, signaling a level of systemic risk that is completely off the charts. Let's start with the most reckless of the three, government debt. As of December 2025, the U.S. national debt alone has exploded to a staggering $38.4 trillion. To put that in perspective, it's jumped by over $2.2 trillion in the last year alone. That's an average of $6.12 billion in new debt every single day. By the time you finish this video, millions more will have been piled on. For years, the defenders of this wild spending spree argued it didn't matter. With interest rates near zero, borrowing was practically free. Well, that era is over, and the consequences are now hitting with the force of a freight train. The cost just to service this debt, not pay it down, just cover the interest, is exploding. For the 2025 fiscal year, the net interest paid on U.S. debt ballooned to nearly $1 trillion. 5 years ago, in 2020, that same figure was just $345 billion. We are burning almost $1 trillion a year on interest alone, an amount that now rivals the entire U.S. defense budget or Medicare. This is the definition of a death spiral. The more debt grows, the more interest payments balloon, forcing the government to borrow even more just to stay afloat. And this isn't just a U.S. problem.
Across the globe, from Japan to Italy, governments are drowning in debt. Their finances held hostage by decades of irresponsible spending.
The second head of the monster is corporate debt. Those same easy money policies let corporations go on an unprecedented borrowing binge. Global non-financial corporate debt is now closing in on $100 trillion. For over a decade, companies were rewarded for taking on massive leverage. They borrowed not just to invest and grow, but to buy back their own stock, artificially juicing their share prices and executive bonuses. While some analysts note that private debt as a share of the economy has stabilized recently, the absolute dollar amount and the recent booms in sectors like AI have been fueled by this easy money, with companies borrowing billions on the promise of future growth. This strategy works in the short term, but it plants a time bomb on their balance sheets. When a slowdown hits or interest rates stay high, these heavily indebted companies face a brutal choice: slash costs, lay off workers, or face bankruptcy. A maturity wall is fast approaching, where trillions in corporate debt will need to be refinanced at much higher rates, a moment that threatens to trigger a wave of defaults. Finally, we have the third head, household debt. Globally, households owe around $64 trillion. While the ratio of household debt to the economy has fallen in some developed nations, the reality on the ground is grim. Persistent inflation has stretched family budgets to the breaking point. Savings have been wiped out, and people are leaning more and more on credit cards and other high-interest debt just to cover the basics. The average person is more financially fragile than ever. They have no cushion. A sudden economic shock, like a job loss or another price spike, could unleash mass defaults on mortgages, car loans, and credit card payments. When you put these three pieces together, the picture is terrifyingly clear. Our governments, our corporations, and our families are all leveraged to historic highs. The very foundation of our modern economy is no longer built on savings and production, but on an ever-growing mountain of borrowed money. And that foundation is starting to crack. If that mountain of debt is the explosive, then the wild speculation in financial markets is the gasoline poured on top. The system isn't just leveraged, it's hyper-leveraged in ways that are deliberately hidden from public view. The most glaring example of this is margin debt. Let me break this down. Margin debt is money that investors borrow from their brokerage firms to buy more stocks. It's pure, unfiltered leverage, a way to amplify your bets. If you have $10,000 and borrow another $10,000 on margin, you can control $20,000 worth of stock. If the stock goes up 10%, you've just made a 20% return on your money. But if it goes down 10%, you lose 20%. It is the ultimate gauge of market speculation and greed. As of late 2025, reports showed U.S. margin debt had surged to a record of around $1.2 trillion, with a staggering year-over-year growth of about 45%. This isn't the sign of a healthy, optimistic market. This is a sign of outright euphoria, a speculative frenzy where investors are so convinced stocks only go up that they're borrowing record amounts of money to chase returns. History gives us a chillingly clear lesson on what happens next. Every major speculative peak in modern history was preceded by a massive spike in margin debt. It happened just before the dot-com crash in 1999-2000. It happened just before the global financial crisis in 2007. And it happened again in 2021 before the painful sell-off of 2022. In every single case, leverage peaked right as the market was about to roll over and crash. That peak in margin debt isn't a sign to buy more, it's the final warning bell before the correction begins. Why is this so deadly? Because of an automated mechanical process called a margin call. When the market dips even a little, those heavily borrowed investors suddenly find their portfolio's value is falling dangerously close to what they owe. Their broker automatically issues a margin call, demanding more cash immediately. If they don't have the cash, and in a panic, most don't, the broker doesn't wait. They have the legal right to start force selling the investor's stocks to cover the loan. Now imagine this happening across the entire system at once. One person's forced selling pushes stock prices down. This triggers a new wave of margin calls for other leveraged investors. Their brokers force sell their stocks, pushing prices down even more. This is the cascade. A small 5% dip can mechanically spiral into a 30%, 40%, or even 50% crash, driven not by a change in a company's fundamentals, but by a tidal wave of forced automated selling. This isn't emotion, it's brutal market mechanics. And if that weren't enough, another key indicator is screaming red, the Buffett indicator. Named after Warren Buffett, who called it probably the best single measure of where valuations stand at any given moment, this indicator compares the stock market's total value to the country's GDP. In a healthy economy, the market should grow roughly in line with the real economy that supports it. As of December 2025, the Buffett indicator is sitting at a mind-boggling 222%. Buffett himself has said that a level around 200% is like playing with fire. We are living in an era of speculative frenzy, completely detached from economic reality and financed by borrowed cash. It's the classic prelude to a historic crash. The most frustrating part of this is that none of it is new. The people running our financial system are ignoring the crystal clear lessons of history. We have seen this exact movie before, multiple times. The plot is always the same. A buildup of debt and leverage, a period of wild speculative euphoria, and then a sudden, violent crash that catches everyone by surprise. Let's rewind to 1929. The Roaring '20s was a decade of technological revolution and wild optimism, a lot like our own. The public believed a new era of permanent prosperity had arrived. This optimism was fueled by an explosion of credit. Everyday people were encouraged to buy stocks on margin, putting down as little as 10 cents to buy $1 worth of stock. When the market started to wobble in October 1929, the margin call cascade began. The forced selling fed on itself, leading to Black Tuesday and spiraling into the Great Depression. The parallel to today's record margin debt is impossible to ignore. Now, let's jump to the year 2000. The mania was the dot-com bubble. Any company with a .com in its name saw its valuation soar to insane heights, whether it had profits or even a business plan. This frenzy was, once again, fueled by record margin debt. Investors borrowed money to buy stocks with no earnings, convinced that this time is different. The AI boom today echoes that same gold rush mentality, with astronomical valuations placed on companies based on a narrative rather than reality. When the dot-com bubble burst, the NASDAQ crashed by over 80%, and fortunes built on leverage were wiped out overnight. And of course, the ghost that still haunts our system, the 2008 global financial crisis. This time, the debt bombs weren't just in the stock market, they were hidden in the housing market. Wall Street created complex derivatives called CDOs, ticking time bombs built from junk mortgages. Banks were handing out loans to anyone with a pulse, with no proof of income. When homeowners inevitably started to default, these safe assets were exposed as toxic. The contagion spread like wildfire. The failure of one bank, Lehman Brothers, triggered a global panic, freezing credit markets and forcing a violent wave of selling across all assets. The common thread running through 1929, 2000, and 2008 is the same. An unprecedented buildup of debt and leverage creates a fragile system. A small trigger, a black swan event, then causes a violent cascading collapse. Today, we have ignored all of these warnings. The system is more leveraged, more interconnected, and more fragile than it has ever been in human history. A bomb needs a detonator. Our financial system is packed with explosives: government debt, corporate debt, and speculative margin debt. The only question left is, what will trigger it all? In a system this leveraged, it doesn't take much. A small spark can ignite an inferno. There are three likely candidates. The first and most probable trigger is higher interest rates for longer. The world got addicted to a zero interest rate policy for over a decade. It was the drug that kept the party going. That drug has now been withdrawn. Central banks had to raise rates to fight the inflation their own policies created. For a government, a corporation, or a family drowning in debt, the difference between a 3% and a 5% interest rate is the difference between survival and bankruptcy. As trillions of dollars in corporate and government bonds come up for renewal, they will have to be refinanced at these much higher rates, creating an instant solvency crisis. The second potential trigger is a deepening recession. Despite the official story, signs of a major economic slowdown are everywhere. Corporate earnings are starting to falter. When profits tank, companies start missing debt payments. This leads to defaults, which creates losses for the banks holding that debt. Fear ripples through the system, credit freezes up, and the optimistic assumptions that justified record high asset prices evaporate overnight. The third trigger is the one we can't predict: a black swan event. This could be a sudden escalation in a geopolitical conflict, a new energy crisis that sends oil prices soaring, a major cyber attack, or a political shock that leads to gridlock and panic. In a healthy system, such shocks can be absorbed. But in a system leveraged to the hilt, a single unexpected event can be the first domino to fall, setting off a chain reaction that can't be stopped. Here is the most likely scenario. A trigger event, whether it's a major corporate bankruptcy or a geopolitical shock, causes an initial dip in the market. A large hedge fund, over-leveraged and facing losses, is forced to sell assets. This initial selling pressure pushes the market down 5%. That dip triggers the first wave of automated margin calls. Algorithmic trading programs designed to sell at certain levels kick in and accelerate the decline. Panic sets in among human traders who rush for the exits. This creates a self-feeding liquidation spiral, turning a minor correction into a full-blown crash in days or even hours. That is the debt bomb going off in real time. So, what can you do? It's easy to feel helpless against such massive forces. The truth is, you can't stop this from happening, but you can prepare for it. You can build a financial arc that will let you weather the storm and even come out stronger on the other side. This isn't about timing the market. Anyone who says they can is lying. This is about managing risk so that when the great deleveraging comes, you are resilient, not wrecked. First, de-risk your portfolio. This means selling the speculative hype stocks that defined this bubble. These are the companies with no earnings, fantastic stories, and sky-high valuations. When the bubble pops, these are the stars that will fall the fastest and hardest. History shows they can lose 90% or more of their value and never recover. Second, build a significant cash position. In a world drowning in debt, cash is king. During a crash, cash is a crucial buffer. It stops you from being forced to sell your own assets at rock-bottom prices. More importantly, it gives you the dry powder to take advantage of the opportunities that will emerge. As Warren Buffett famously said, you must be fearful when others are greedy and greedy when others are fearful. To be greedy when others are fearful, you have to have cash. Third, you need true diversification. The traditional 60-40 portfolio of stocks and bonds is broken. In a rising interest rate environment, stocks and bonds can fall together, offering no protection. True diversification means owning assets outside the traditional financial system. This means hard assets, things that have held their value for thousands of years through every crisis imaginable. This includes physical gold and silver. These aren't just investments, they are insurance against systemic collapse. For those with a higher risk tolerance, a small allocation to Bitcoin can also be considered, as it represents a decentralized alternative to the very system that is at the heart of the problem. Fourth and finally, focus on fundamentals. When the tide goes out, you see who's been swimming naked. In the coming crisis, the companies that will survive and eventually thrive are those with strong balance sheets, low debt, and reliable profits. These are the businesses that produce things the world actually needs, not the ones built on financial engineering and hype. The most important step is a mindset shift. The goal is no longer to chase the highest possible returns. The goal is capital preservation. An informed investor is a defended investor. The evidence is clear and overwhelming. A global debt of nearly $346 trillion has saturated the world economy, inflating asset bubbles to levels that mirror the periods right before the crashes of 1929, 2000, and 2008. The combination of record government debt, unprecedented corporate leverage, and extreme speculative froth from margin debt has created a profoundly fragile system. A trigger is coming, and when it does, the unwind will be violent and automated. This analysis isn't meant to inspire fear, but to promote prudence. While the fearful and uninformed will freeze, those who understand the mechanics of this crisis can adjust their strategy, defend their capital, and prepare to act. If you found this breakdown valuable, subscribe to the channel and click the notification bell for more analysis on how to navigate these uncertain times. In the world that is coming, being informed will be your greatest asset. And now I want to hear from you. What do you see as the biggest red flag right now? Is it the national debt, the corporate leverage bubble, or the speculative fever in the markets? Let us know in the comments below.